Well, investing in investment holding companies comes with many pros and cons, but above all, investors need to have complete confidence in the capital allocation skills of the executives in charge. These skills also need to be able to offset the discount that investment holding companies usually trade at relative to the value of their assets. Nick Norman-Smith from Lentis Asset Management joins us to give us his take on these businesses. And we're starting with Berkshire Hathaway. We had a very excited Corky Koyman yesterday, having just come back from the Berkshire Hathaway conference.
Disciple?
He's a disciple. So he has utmost faith in Charlie Munger and Warren Buffett. Your thoughts? Can we start? Whether you're going to blow Corky Koyman out of the water. Do you believe in their investment strategy?
No, we do. I think it's always very important to separate. We can be disciples of Buffett and Munger.
Are you a disciple?
We certainly are. We've learned a lot from them, and they're highly successful, very intelligent people. But you need to pay the right price. It's the same with any company. You can have this wonderful business with smart management. If you pay too much for it, you are generally going to have a poor investment result. If you look at Berkshire Hathaway, it's something that we have owned for about a year and a half in our client portfolios because we were under the belief that it was trading at a significant discount to its true intrinsic value. Plus, you're getting the benefit of these capital allocation skills of two very smart and relatively elderly gentlemen. And certainly the market...
You added the relatively elderly because we chatted about this, octogenarians.
Octogenarians, that's right.
And this is, so as always, you know, we relatively deep value investors, and we generally buying stuff when people don't like it. And a year and a half ago, people were very negative on Berkshire. And one of the major things was Buffett and Munger are old, how much longer they're going to be there for, what's their succession plan, etc. And we agree, and we take that into account, that they won't be able to do the deals that they've currently done without Buffett and Munger there. Their presence is
Let's be blunt about it. What time horizon are people giving them?
Well, I think they were giving them zero time horizon a year and a half ago based on where the stock was trading at sort of $70, $80. But if you just put them aside and you can look at the company in three parts. One, the listed stocks, so they own Coca-Cola, American Express, various other good listed businesses. And then they've got a private equity portfolio. They've got around 68 unlisted businesses, everything from railroads to food companies to sweet companies, etc. And then they've got an insurance business, which has consistently actually made an underwriting profit, which is an exception. If you value the insurance business at zero and say, look, they're just going to break even and they're not going to actually make money, but they at least get all the float from the insurance business to invest, you value the stocks at market value, and a lot of them are actually undervalued. Certainly they were a while ago, they have re-rated since. And you put a very conservative multiple on the private businesses, you still come out at a value that's significantly below where the stock is trading.
But you've articulated that quite well, Nick. But I mean, these two are also very good at telling the market where they think that the stock price of Berkshire Hathaway is cheap and where it's expensive. So what do you think led to that ability to pick up the shares at a good price? And you've obviously seen the fruits of that since.
I think there was a really, and probably still is. I mean, I think one of the reasons is the market is generally buoyant, but you know it has outperformed. So over the time that Berkshire's gone up 40, the S&P's gone up 14%. So part of it is market buoyancy. They've grown the intrinsic value of the business. So perhaps they've just demonstrated that. So you know they did a deal where they bought Heinz, the ketchup maker. Now they actually paid quite a rich price for the equity. But what they did, and this didn't get nearly as much airtime, is they lent a lot of money into the deal. So they provided preference shares and bought them at a yield of around 8.5%. Now, in the current environment, who in the world can get an 8.5% dollar yield? Only Warren Buffett. So those deals have brought the value up significantly, and a lot of their underlying holdings have re-rated as well. So we don't expect that there are going to be too many Heinz deals in the future because Buffett and Munger will disappear. But the underlying businesses are strong enough that you're still buying a very attractive investment.
Can we come home now?
Yeah, we can.
Let's talk a little about the investment holding companies in South Africa, and perhaps starting with the one that you deem to be the hottest in the sector.
From a valuation point of view, we think Steinhoff is very attractive. So it's not that diversified if you actually look at the value. The vast majority of what you're investing in is European retail. They went and bought Conforama. So Steinhoff are effectively now the second biggest furniture retailer in Europe.
To
IKEA. So let's not beat around the bush. You're investing in European retail. So now you start understanding why this stock is cheap. people aren't interested in Europe. There's all sorts of issues, etc.
Certainly sounds like a value manager's playground.
And Europeans aren't interested in furniture either at the moment.
Exactly. But what's interesting is even if you do believe things are going to be tough in Europe, they are at the lower end. So if people are trading down, they're going to be there. Why we really like it is they made the acquisition in 2011. Property prices are, and general asset prices are very cheap. There's a big property underpin. Again, we don't know exactly when the European property cycle is going to turn, but it's certainly closer to the bottom than it is to the top.
Well, judging from the fact that they're closing down television stations like ERT out of Greece, so this could be a phenomenon across Europe. Things aren't going to get better anytime soon. You could see more downside on these prices.
You could, exactly, but you know, and we need to sit and wait and be a little bit patient. But if you look at the underlying valuation fundamentals of the property, it's cheap. So you've got that real hard asset in property. You've got the retail business, which is under pressure, but will eventually turn. People are still going to need beds and couches eventually. I don't think everyone's going to completely leave Europe. And then they've got a number of other ancillary investments, small exposure to, in the grander scheme of things, to JD Group, PSG, CUP. And they've sort of done quite a lot of restructuring, and they've got some to tie in with the furniture. They've got a manufacturing business in Eastern Europe, so they make the stuff in the cheap regions and generally sell it.